Hi guys, this is Sia Jain and welcome back to my YouTube channel ACCA and Beyond, and we are going to be continuing with our revision series. The chapter we have already started is completion and review, which is chapter number 11, and we were talking about going concern and other things, and we'll move to audit procedures right now. And this is where you pick up easy marks if you structure your answers properly. So first, the procedures to assess management's evaluation. First, the auditor checks management's work, evaluate management's going concern assessment, make sure they've considered at least 12 months, if not, ask them to extend it, and check have they included all relevant information. Okay, and now when procedures when there is a doubt over going concern. Now this is an important part. If there are red flags, the auditor goes deeper. So, first, analyze cash flow forecast and profits, but not blindly. Check if the assumptions actually make sense. Review latest interim financials to see the most recent performance. Check loan agreements, have any items been breached. Read meeting minutes, any signs of financial trouble. Talk to lawyers, are there any legal cases that could cause big losses. Verify financial support. If someone promised funding, is it real? Can they actually pay? Look at subsequent events. Do they improve or worsen the situation? Check customer communication, any disputes, risk of not getting paid, and check supplier communication, any payment issues or supply disruptions. Review bank correspondence to check if loans or overdrafts might be withdrawn or recalled, and obtain a written representation from management, basically confirming their future plans and how they deal with going concern issues. Now, here's a very important exam tip. When thinking about going concern, focus on cash, okay, not profit. Yeah, because company can survive without profit for some time, but not without cash. So always think, how much cash is coming in, how much is going out, can they pay their debts when it's due? Now let's talk about reporting. Another favorite exam area. If directors do not properly disclose material uncertainty or use the wrong basis, the auditors will modify the audit opinion. But if everything is properly disclosed or financials are correctly prepared on breakup basis, the auditor gives an unmodified opinion but adds extra communications like emphasis of matter. Now, finally, cash flow forecasting testing. This is how auditors actually check if the company can survive. First, check accuracy. Match opening cash balance with the cash ledger. Second, look at past forecast. Were they reliable? If yes, more confidence now. Third, evaluate assumptions. This is a big one. For example, bad economy, sales shouldn't magically increase. If there's rising cost, cash flow outflow should also increase. So, if assumptions look unrealistic, it's a huge red flag. So, final takeaway from this section would be cash is king, question the assumptions, and always link it back to whether they can actually survive. Yeah. So, sorry, just give me a second. Alright, now we are at the final stage of the audit, the overall review. This is basically the auditor stepping back and asking, does everything make sense as a whole? Before giving the audit opinion, we don't just rely on individual testing. We do a big picture review of the financial statements. So what does this include? Reviewing the financial statements, of course. First, we check compliance. Are the financial statements following accounting standards and legal requirements? This is often done using a disclosure checklist. Are the accounting policies properly disclosed? And do they match what's actually being used in the financial statements? And most importantly, do the financial statements reflect everything we found during the audit? Basically, nothing should contradict our earlier conclusions. Second, analytical procedures. Now we step back and look at trends. One second. Sorry. So I'll pick up where I left off. We perform analytical procedures to confirm whether the numbers make sense overall and check if the financial statements are consistent with our understanding of the business. Third, is about uncorrected misstatements. We review all the errors that management didn't correct. Individually, they might seem small, but together they could become material. If that happens, the auditor will discuss it with management and push for adjustments. Uh, Now we'll understand the review procedures. This is more conceptual but very scoring if explained properly. Think of it as a quality check of the entire audit. The review is part of the quality management, basically making sure the audit was done properly before we sign off. So, what is the auditor checking here? First, Was the audit conducted according to the professional standards? Second, were all important issues identified and properly discussed? Nothing major should be ignored. Third, do we need to change our audit approach? Maybe new risks came up during the audit? And most importantly, do we have enough appropriate evidence to actually support our opinion? Because without sufficient evidence, the opinion means nothing. Also, the auditor needs to step back and ask, are our initial assumptions still valid? If things change during the audit plan should have been updated accordingly. Now let's move to the evaluation of misstatements, another key exam area. First step, record all misstatements, unless they are clearly trivial. Then check, do these errors exist? Do these errors suggest that more errors might exist? If yes, we may need to revise audit plan. Next, communicate all misstatements to management and ask them to correct them. Now here's the tricky part. What if management refuses? Then the auditor must understand why they are refusing and consider this when deciding whether the financial statements are materially misstated or not. Alright, now let's focus specifically on evaluation of undercorrected misstatements. This is where judgment really comes in. So, imagine this situation. Management has refused to correct some errors. Now, what does the auditor do? First, reassess materiality. Because if management is refusing to correct errors, the risk level increases. So, the auditor needs to ask, is my original materiality level still appropriate? Second, evaluate the misstatements. Now we look at all uncorrected errors, individually and in total, aggregate. And here's the key, consider both size and nature, because sometimes a small error can still be material due to its nature. Also remember, an individual material misstatement cannot be hidden by offsetting it with another error. Third, communicate to those charged with governance. So, not just management now, this goes to a higher level, like directors or audit committee. And the auditor must clearly explain how these uncorrected errors will impact the audit opinion. Finally, written representation. The auditor will request written confirmation that management believes these uncorrected misstatements are immaterial. Okay, now let's talk about written representations. A small topic but very easy marks if you explain it properly. So, first, what is it? A written representation is basically a written confirmation from management to support certain matters in the audit. Think of it as like management saying, everything we've told you, we confirm it in writing. Now, what's the purpose of this? According to ISA 580, auditors obtain written representations to confirm a few key things. First, the management has fulfilled its responsibility for preparing the financial statements. Second, to support other audit evidence, especially where strong audit evidence is not available. Third, that the auditor has been given all relevant information. And fourth, that all transactions have been recorded properly. Now, here's the important part. Written representations are usually used when better evidence is not available or when the matter involves management judgment, because some things only management really knows. Examples, whether accounting policies are appropriate, whether assets and liabilities are properly measured and disclosed, our plans or intentions that might affect asset valuations, existence of liabilities including contingent ones, and ownership or control over assets. They also confirm things like compliance with laws and regulations, including any non compliance, that directors have told the auditor about any internal control weaknesses, and specific assertions where management judgment is involved. Now, here's a very important line for exams. Written representations are not a substitute for other audit evidence, and on their own, they are not sufficient appropriate evidence. So always remember, they only support other evidence and they never replace it. Now, let's quickly understand the process for obtaining a written representation. The auditor actually drafts the letter, but it must be printed on the client's letterhead. This can be easily asked for an MCQ. It is addressed to the auditor and signed by senior management, usually the CEO or the CFO. The date should match the date of approval of the financial statements, and it must be signed before the audit report is finalized. Now, let's talk about the reliability of these written representations. Um, because this is where judgment comes in. Written representations are created by the client, so yes, there can be bias. That's why auditors need to question: is management trustworthy? Does this match other audit evidence? And finally, what if something doesn't match? If written representations are inconsistent with other evidence, reconsider their reliability, reassess audit risk, and perform additional audit procedures. Alright, let's cover the final exam focused points on written representations. First, a very important exam tip. Whenever you mention a written representation as an audit procedure, you must clearly state what it is confirming. For example, obtain a written representation from management confirming the completeness of directors' remuneration, including bonuses. So just don't write obtain written representation, always link it to the specific scenario. Now, let's talk about serious situations. What if there are concerns about the management's integrity? In that case, the auditor must assess whether the audit can even be conducted properly. If not, the auditor should withdraw from the engagement if legally allowed. If withdrawal is not possible, then this will likely lead to a disclaimer of opinion. Now, another important scenario. What if management refuses to provide written representation? Remember, even though they are weak evidence, they are still necessary. So, the auditor should first discuss with management to understand the reason. Second, reassess management's integrity because refusal is suspicious. And third, consider the impact on the audit report. And finally, we are going to talk about reporting implications. The auditor will issue a disclaimer of opinion if there is a serious doubt about management's integrity or management refuses to provide key written representations, likely responsibility for financial statements or completeness of transactions. So, always explain what the representation is for. And I guess with this, we have completed your chapter number 11. If you really like this video, if you thought it was helpful for you, please share it to your friends, like and subscribe to my channel, and thank you so much for watching.